Time for another quarterly video update for Zacks Income Investor Service, and the editor of the service, Neena Mishra, is here with me now to talk a little bit about what's been going on with it. First, let's talk a little bit about the market. What do you make of what's going on in market activity here lately?
Yeah, so I remember when we had the last quarterly video update, we were discussing the Trump trade.
Right.
And after election, all domestically focused stocks, particularly in the financials and industrial sectors, were rallying in hope of, faster economic growth and a stronger U.S. dollar. But the Trump trade has completely unwound over the past few months because of the ongoing political drama in Washington. There's a lot of uncertainty whether Trump would be able to carry out his agenda of tax reforms or deregulation or fiscal stimulus. But stocks have still been rallying. In fact, last week we saw the worst sell-off of the year in one day, and stocks recovered quickly because the corporate earnings have been much better than expected, and global growth has been picking up. And because of this pickup in global growth, all large companies, multinational companies, particularly tech companies which have a lot of overseas revenue exposure, they have been doing really well of late. So I expect that trend to continue for some time because growth in Europe and in the emerging markets has been much better than expected. So all larger companies may continue to outperform the smaller domestically focused companies, at least for some more time.
So is the market ignoring Washington for the time being?
I think the risk is there, but the market has been kind of ignoring on most of the days, unless there is a really negative news like we saw last week. But I think investors are choosing to focus on better than expected earnings and better than expected global economic growth.
More fundamental factors.
Yes, more fundamental factors.
All right,
That's
well,
correct.
we have a Fed rate hike kind of baked in for the month of June.
Yes,
right?
Yes, so that is kind of almost priced in by the market. The current Fed fund rate shows that there's more than 80% probability of a rate hike in June, and that is what we understood from the recent Fed minutes. Also, it seems they are all set for a June rate hike, unless, of course, this Friday's jobs report is much worse than expected. And the Fed has also talked about normalizing the 4.5 trillion balance sheet, and if the economic conditions continue to improve, probably they will start trimming the balance sheet sometime later this year. But what we have seen so far from their minutes and from press conferences done by the Chair Yellen, that it seems that they are going to be really cautious, and any approach that they take in hiking the rates or normalizing the balance sheet is going to be very, very gradual. And because of this cautious stance, we have seen that even rate sensitive assets, including bonds and bond-like sectors, utilities and REITs, etc., they have also done well this year, though investors had expected. The market was talking about a steep sell-off in bonds and bond-like sectors because the Fed would start raising rates this year, but that has not happened.
All right, well, that jobs report from the government that you mentioned comes out on June the 2nd, to put a date on it. So how does everything that we just talked about impact the portfolio?
So my goal is to keep the portfolio very diversified because it's a long-term investor service. So a few months back, we had started adding and increasing exposure to the technology sector, because the growth in the US and all over the world was picking up, and most of our technology stocks have done really well this year. We had also added some retail stocks because I had expected that this economic growth and improving labor markets and improving wages would lead to a rise in consumer spending. But retail stocks have not done well this year, mainly because of the Amazon effect.
Sure.
And as of now, we don't have any exposure to retail. I have added some stocks and ETFs in the portfolio recently, which are positioned to benefit from the improving global economy. Stocks like Rio Tinto and Caterpillar. I have also added Europe-focused ETF and another ETF which focuses on mega cap multinational companies. So I expect them to do well going forward. And as I mentioned, at the same time, I will try to maintain a very diversified portfolio, because over the long run, these diversified portfolio always have a much better than market risk adjusted return.
Is the technology rally fizzling out?
We saw some outflows out of technology funds in May, even though stocks have continued to do well. And I don't think the rally is fizzling out. I think some investors took profit because it was too much in a very short time. The rally was, it was a big rally in a short time. But I think because of their global exposure and improving global economy, technology stocks, particularly large cap technology stocks, will continue to do well. And if we manage to get any tax repatriation holiday deal, then most of these large cap technology stocks are going to benefit, because they have a lot of cash parked overseas, so they will be able to bring them back in the US, bring the cash back into the US and use that maybe for special dividends or share repurchases, or for increasing their dividends, or for mergers and acquisitions.
And along with the importance of diversification, important to note also that this is a long-term holding service.
Yes,
right?
exactly.
So you need a longer time horizon.
Yeah, we always have a longer term focus when we select the picks for this portfolio.
All right, well, we thank you for checking in. And in between these video updates, don't forget, you've always got the written commentary that Neena sends direct to your inbox. With Neena Mishra, I'm Terry Ruffalo.